What if gold's sustained climb over recent years wasn't a reflexive hedge against uncertainty, but the visible trace of a deeper, slower shift? A reallocation of trust that began long before headlines caught up. At first glance, the rally seemed familiar enough. Prices started edging higher in 2022, accelerated through 2023, and carried into 2024 and 2025, breaking into record territory. The usual explanations followed: inflation anxiety, geopolitical stress, turbulence in equities and bonds. Gold, the conventional safe haven, appeared to be acting on cue. Yet this cycle behaved differently. Instead of the sharp spikes and violent corrections typical of crisis trades, the ascent was deliberate, a measured accumulation more than a scramble for safety. Volatility remained subdued. The pattern suggested steady repositioning within the architecture of global confidence, rather than speculation chasing momentum. By the early 2020s, that architecture itself was under strain. Fiscal and monetary credibility had become stretched across advanced economies. Sovereign debt levels reached thresholds once associated with total war. The United States exceeded 120% of GDP in federal obligations, and servicing costs grew into one of the largest and fastest rising components of the budget. Central banks attempted aggressive rate normalization in 2022 and 2023, but each tightening cycle ran into the same structural constraints: debt servicing, asset market fragility, and political fatigue. Higher rates proved temporary, policy normalization elusive. Amid that backdrop, gold's role began to change. Starting in 2022, official sector accumulation accelerated dramatically. Central banks became the largest net buyers in half a century. The World Gold Council recorded annual purchases exceeding 1,000 tons in both 2022 and 2023, more than double the historical norm. This was not yield-seeking behavior. Gold pays no interest, carries no counterparty exposure, and confers no political leverage. Its appeal lay precisely in those absences. It functions outside the machinery of credit and settlement. The list of participants told its own story. Russia continued to build reserves after portions of its foreign assets were immobilized. China steadily expanded its gold holdings, reducing reliance on U.S. treasuries and other foreign sovereign debt. India, Turkey, and several other emerging economies followed suit, broadening diversification away from dollar-centric reserves. Notably, many of these purchases occurred during quiet market phases, when prices consolidated rather than surged, a hallmark of strategic accumulation rather than tactical trading. Meanwhile, the assumptions underpinning global financial infrastructure began to erode. The freezing of sovereign reserves, politicization of payment systems, and increasing friction in cross-border settlement demonstrated that liquidity was no longer neutral. Assets once considered universally safe now carried jurisdictional and policy risk. Gold, in contrast, remained one of the few assets that settled physically and finally, independent of digital clearinghouses or correspondent banks. On the supply side, constraints deepened. Global mine output had grown by barely 1 to 2% annually over the previous decade, despite higher prices. Exploration success declined, ore grades fell, and environmental approval timelines lengthened. The vast majority of above-ground gold remained locked in long-term holdings, reserves, jewelry, or private hoards, unavailable as flexible supply. The cost of bringing new projects online climbed steadily due to labor shortages, ESG mandates, and energy inflation. Recycling, which historically provided nearly a third of global supply, also stagnated as long-term holders refused to part with physical metal. Yet price discovery continued to hinge on the paper market. Futures and exchange-traded funds generated daily turnover far exceeding physical trade. As sentiment oscillated, temporary sell-offs were often misread as failed rallies, even when underlying physical demand, from central banks and Asian buyers, stayed firm. Western investment flows weakened, but that weakness only highlighted the east-to-west divide. In China, retail bar and coin purchases surged. In India, festival demand remained resilient. In Turkey and the Middle East, citizens turned to gold as protection against currency volatility. When financial conditions tightened and risk assets corrected, gold did not suffer the usual reversal. Central bank purchases continued. Physical premiums widened in multiple regions. The narrative of speculative exhaustion repeatedly failed to materialize. Even as the Federal Reserve reduced its balance sheet, other parts of the world quietly rebuilt trust in tangible reserves rather than promises of liquidity. Viewed historically, the behavior made sense. Gold tends to move not when confidence vanishes, but when it reconfigures. Its signal is rarely an explosive surge. It is quiet resilience when other narratives lose coherence. From that perspective, the rise that began in 2022 was not driven by fear of imminent collapse. It was driven by recognition that assumptions long treated as permanent, debt sustainability, monetary flexibility, frictionless access to reserves, were gradually being rewritten. A new layer of monetary realism was forming, one that recognized the limits of policy, the politicization of liquidity, and the fragility of trust in fiat architecture. Markets can describe such behavior as caution. Policymakers might prefer to call it diversification. History is more candid. It calls it preparation. Gold did not rally because collapse was expected tomorrow. It rallied because permanence could no longer be taken for granted. And that is why the move started well before the world realized it had begun. If you value historically grounded analysis of economic trends, consider subscribing to this channel.